How 40, 50, and 60-year mortgage terms would affect your monthly mortgage payment. Currently, we're in a market with higher housing prices. We're also seeing higher than normal interest rates. Because of housing prices increasing, we're also seeing property taxes increase on a faster than normal base, typically every year so far, probably in the last 3 or 4 years. We're also seeing an increase in the cost for homeowners insurance. So coupling all of those items together, because inside of your payment, you have principal, interest, taxes, and insurance. And depending on the type of loan you get, could potentially be mortgage insurance. With all of those things being included in your payment, we've seen an increase in monthly mortgage payments. Buyers are not wanting to pay higher mortgage payments. In some cases, they can afford it per the lender, us looking at their gross income that's available, but they also may not be able to afford it because they have other obligations that we don't have counted into their debt to income ratio. Aside from that, some people just don't want to pay a higher payment. You know, if you're looking for a $500,000 house, you're not going to get a $2,500 mortgage payment. A $2,500 mortgage payment is it's a lot of money. A $2,500 mortgage payment is a substantial amount of money to pay on a monthly basis on top of additional bills that you have or expenses you could incur. Now, a few ways that you could potentially solve the issue of having a higher or getting a lower mortgage payment. One way that you could potentially lower your monthly payment is shopping around for homeowners insurance. As you shop around for homeowners insurance, you want to make sure you get enough coverage in case you actually need the homeowners insurance for fires, theft, wind damage, acts of God. You also, some people ask, well, if I put down a larger down payment, does that help me with my monthly payment? It does have an effect on your monthly payment. However, from experience, instead of putting down a larger down payment, if one is not required, I would look into potentially buying the option of buying down your interest rate. And they have different programs for 2-1 buy down, 1-1 buy down, 3-2-1 buy down. If you want to learn more about how to buy down your rate, the link will be in the video below, so you can watch the video on what 2-1 buy down is or the 3-2-1 buy down is. You also have the ability to go lower in housing price, right? Sometimes the house that we want and the payment we want don't match. They don't work together. And what you need to do is take an assessment of what you are willing to pay on a monthly basis and what type of house you're looking to get. In some cases, as a buyer, you could potentially not look for your first home to be your forever home and start out with something that would be maybe smaller than what you were expecting or needs a little bit more TLC than you expect. However, you get the house that you want and close to the payment you want, or you're close to the house that you want and the payment that you want. So, however, if you shopped around for your homeowner's insurance, you've did a 2-1 buy down or buying down the rate, you've potentially, shopped around for a better mortgage interest rate if that's the case, or you have put down a larger down payment, the next option I believe that we could potentially look at to help housing prices or monthly mortgage payments, the high monthly mortgage payments get solved, is to increase the period of time that you have on mortgages. So right now you currently have a 15-year, 20, 25-year, and a 30-year mortgage. The 30-year mortgage stretches the mortgage payment out for the longest period of time currently. So typically when a person applies for a mortgage, they're typically, unless specifically asked, the lender is typically going to quote you on a 30-year fixed mortgage, which is stretched out over the life of the loan. What I found is that people are used to being able to stretch their payment out if they're used to a car. So example, if someone's car payment is $550 and they're not willing to pay that, and let's say that's on a 4-year term, 48 months, company that's financing the car could potentially expand or take that out to, let's say, 72 months. If they can take it out 72 months, that lowers the car payment, right? So that's what people are used to. However, when you're getting a mortgage, we're talking about $400,000 versus $40,000. That stretches it out over 360 months from the beginning, unless you specifically ask the lender to quote you on 20 or 25 year or maybe even a 15-year mortgage. So far, if this video has been helpful to you, please do me a huge favor and give me a thumbs up. And if you're new to the channel, please hit the subscribe button and get notified as to when we go live or a new video is posted. If we extend mortgage payments to 40, 50, and 60-year mortgages, it will have a direct effect on your monthly mortgage payment. If everything else stays in place, meaning your taxes, insurance, principal, and interest remain the same, and we expand the amount of time that the mortgage is due in terms of the 40-year, the 50-year, and the 60-year, we'll see a difference in monthly mortgage payments. And this will potentially do two things. It potentially can get the buyer at the monthly mortgage payment that they would like to have. And it also could potentially allow for more buyers to qualify or a buyer to qualify for more home. So let's go to the calculator and let's take a look at what your payment will look like at 30 years. And then we'll also do 40, 50, and 60 years. So let's look at a $400,000 home, conventional financing, 5% down. We're going to use an interest rate of 7.25, annual taxes of $4,000, annual insurance is $2,500. So in the annual taxes, we're looking at $333.33. Insurance, we're looking at $208.33. And private mortgage insurance, we're looking at $158.33. So on a 30-year fixed mortgage with all of those terms, we're looking at a monthly mortgage payment of $3,292.27, right? So let's extend that rate out to 40 years, that term out to 40 years. We're looking at a payment of $3,130.75, which saves us about $161 a month. Let's extend that even further to a 50-year note. On a 50-year note, we're looking at $3,000 and approximately $3,060, right? $3,060 a month, which saves us $233. Let's extend that to 60 years. So we're doubling the term, right? That takes us to $3,026.25, which roughly saves us about $266 a month. Now, with all of that being said, is $266 a month a lot of money? Not necessarily, right? However, it changes a lot of things. It changes what your monthly mortgage payment is, right? It also, in this instance, it could potentially qualify you when you couldn't qualify for a 30-year mortgage because your debt to income ratio may be higher. So that $266 now allows for you to qualify for the $400,000 home. You definitely want to think about it, right? If they extend the payments over time, you're paying a huge amount more in interest. Like I spoke of earlier in the video, you do have the ability to pay down on the principal. If you're not looking to stay in your home that long, you could potentially use that product to get into a home. Now, of course, we don't have 40, 50, 60-year mortgages. However, I think that this is a potential solution because one of two things, and this is just my opinion, I think that housing prices will continue to stay up because of the housing shortage. And even if you drop the mortgage interest rate, that still doesn't solve the housing crisis. If you drop the mortgage interest rates and they say it needs to get somewhere to around 5.5, in order for it to happen, you're going to see a lot more buyers in the market. A lot more buyers in the market could bring up a lot more of competition. And from there, then housing prices continue to increase. If this video has been helpful, definitely hit the subscribe button. And if you would like more information, my contact information will be below. Also, the link to our free newsletter and Facebook group will be below.